You've got questions about credit scores? I've got answers. Not to be braggadocious, but my credit score is nearly perfect, and I want to share with you what I have learned in order to make it that way. Your credit score can significantly impact your financial future, so it's really important that you understand what it is, how it works, and what you can do to make it as high as possible. So that's exactly what we're going to be talking about in today's video. Hi guys, I'm Sam. Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a three-part strategy. Earn more, spend less, and invest the rest. Now we are a new channel hoping to grow, so if you like this video, please subscribe to our channel. We'd really appreciate it. Today's video is an A to Z guide for understanding credit scores, how they're calculated, why they're important, and much more. And if you stick around until the end, I'm going to share with you the 7 most effective things that you can do to improve your credit score. Let's get started with our first question. What is a credit score? A credit score is a number that is derived through statistical analysis that gives an indicator of a person's credit worthiness. In other words, this is a score that lenders use to predict the probability that an individual is going to repay their debt in a timely manner. A credit score is based on several factors that have to do with a person's financial behavior and history, and we're going to talk about those in more detail a little bit further on in the video. How does your credit score impact your life? Well, the short answer is it impacts your life a lot. Your credit score is one of the key factors that is going to enable you to have access to borrowing money and take on good debt. Now, if you're interested in learning more about good debt versus bad debt, Chris recently did a video on this, and I'm going to link it in the description below in case you'd like to check it out. Put simply, the better your credit score, the more attractive you are to a lender. It can be the difference between you qualifying for a really important loan, like say for that of your mortgage on your home or for a vehicle that you need to buy. And it can also directly impact the interest rates that you are going to pay for that loan. So to illustrate this example, let's head over to myfico.com and let's do a quick comparison of what you would end up paying in interest on a 30-year mortgage depending on your credit score.
All right, guys, so I went to the myfico.com website and they have a loan savings calculator. I will link it below in the description. What I like about this calculator is that it's really easy. There's only 4 steps and it will give you a really good estimate on exactly what having a better credit score will do for you in terms of a loan. So step 1 is that you select the type of loan. In this example, I've stuck with the 30-year fixed. And then in step 2, you can select the state you live in. Now, for this example, I'm going to keep it at national, but as you can see, you can select whatever state you live in to get more accurate results for your situation. Now, the final thing is that you enter in the principal loan amount, and for our example, I've chosen the amount of $300,000. Now, step 4, this is where things get interesting. You can pick your credit score range. Now, I am going to choose the number of 700 to 759. And then I'm going to hit calculate and let's see what happens. Oh man, okay, I love seeing this. So here you can see if your score changes to a better score, 760 to 850, you could save an extra $12,000. But what's crazy is if you look at what would happen if your score lowered. So say for example, you dropped, something happened, and your credit score went to between 620 to 639, you would end up paying an extra $82,000. And you can see on this table what a huge difference it makes in terms of total interest paid to the loan based on that FICO score. It's really crazy to see, but I love this calculator because it gives a simple, real-world example of what it looks like and what are the benefits of having a better credit score.
Moreover, your credit score can impact other aspects of your life, such as whether a landlord is going to let you rent an apartment or not. Some employers look at credit scores before they will decide if they want to hire you. And in many states, your credit score also affects the amount of premiums that you're charged for insurance. So your credit score is a really important thing that you need to understand, that you need to know, and that you need to have control over. What is a bad score and what is a good score? People with credit scores below 640 are typically considered what they call subprime borrowers. So basically what this means is that the bank considers lending you money to be more risky. And so as a result of them taking on that risk, they are going to charge you a higher premium or a higher interest rate, or maybe give you penalties or fees, or maybe they'll ask somebody to co-sign on one of your loans. So in summary, because they think you're more risky, they want to get more of a financial reward for taking on that risk. A credit score of 700 or above is typically considered good, and once you hit that threshold, you will see significant advantages in terms of lower fees or better opportunities for borrowing money. Credit scores that are above 800 are considered to be excellent. Are there different types of credit scores, and which one should I be worried about? Well, first things first, you do not have a single credit score, you have many, and they are calculated by lenders using different calculations and different parameters that they are specifically looking at. Therefore, the thing that you should be most concerned with is your credit range. So for example, good, very good, exceptional, because the range is what's going to determine the amount of fees and the types of loans that are available to you. There are 3 major credit reporting agencies in the US, and that is Equifax, Experian, and TransUnion. Their job is to report, store, and update a consumer's credit history. There are 2 major competitors in the business of creating scoring models to judge the credit worthiness of a consumer. And these 2 competitors are VantageScore and FICO. So it's important for you to note that a FICO score is a type of credit score. To go back to the question of which one you should care about, the answer is your FICO score. For the past 25 years, the FICO score has been the one that has been used by most of the big banks, most of the lenders. In fact, 90% of institutional lenders are going to be looking at your FICO score. So that is the one that you need to be paying attention to the most. All right, this brings me to a very important side note. Now, I'm sure you have seen those ads for websites that say, click here to boost your credit score, or click here to get a free credit report. Now, while I'm all about promoting financial literacy and awareness, there are some red flags that you need to be aware of when you engage with websites like these. Red flag number 1 is that not all of these sites report your FICO score. And although in theory, whatever they show you should be within the range of what your actual FICO score is, I have seen reports where the scores have differed as much as 100 points. So I give you this word of warning to make sure that if you are going to engage with these websites or even pay to get a copy of your credit score, that it's really important that you make sure that you are getting your FICO score and you know exactly what it is you are receiving. Red flag number 2 is that a lot of these sites that give you a free credit report, like Credit Karma, have some fine print that you sign off on, which basically allows them to get a detailed history of your spending habits, and then they share those spending habits with advertisers so that they can give you more targeted advertisements. Now, if you're a Facebook user, this is also a terms and service that you've agreed to, so maybe this isn't a big deal to you, but I think it's really important that you're aware of what privacy you are giving up in exchange for that free credit report. And finally, before we move on to the next question, it's really important for you to understand that there are actually different types of FICO scores. Now, the way that FICO works is that they are an algorithm company and they're the ones that are setting the score. And so what happens is that they come out with different versions of their scoring models. Now, it's up to the lenders to decide if they want to adapt the new scoring model or if they are going with an old scoring model. There's also some industry-specific FICO scores. So basically, even though they're going to be similar ranges, it's important for you to know that there are different variations of that FICO score, and ultimately what it boils down to is the lender's choice on which version they are going to use. What makes up your FICO credit score? Okay, so your FICO credit score is made up of 5 key factors, the first of which is your payment history. And this is the biggest and most important part. It actually comprises 35% of your score. Essentially, it's pretty self-explanatory. What they want to see is that you pay your bills on time, because this is the #1 risk factor that a lender is taking on when they lend you money. So that payment history is a big chunk of what your score is made up of. The next factor is amounts owed, and amounts owed comprises 30% of your score. So essentially what lenders are looking at is they want to make sure that you are not overextended, because they don't want you to be at risk of defaulting on the loan. So it's okay to owe money in different places, but what they want to see is that you don't owe excessive amounts of money. The next factor is the length of your credit history, and this makes up 15% of your score. So as a rule of thumb, the longer your credit history is, the better your score is going to be. Although there are certain cases where young people, if they have other good things working for them, they still have a high credit score, even if they have a short credit history. Essentially, they're going to be looking at many financial metrics in terms of the length. So things like how long your credit history has been established, what's the length of your oldest account, how long has it been since you used certain accounts, things like this. So this marker is really a time metric. The next thing that comprises your score is your credit mix, and this makes up 10% of your score. So what they want to see is a healthy mix of things like credit cards, loans such as a mortgage. They'll look at your retail accounts and some other factors. So basically what they want to see is what types of borrowing are you doing, and they want to see the mix of the type of credit that you have taken out. And then the final factor is what's called new credit, and this also comprises 10% of your score. So research shows that opening a lot of new accounts in a short period of time poses a high risk. And so if you are doing that, it is a red flag to the lenders, and so this will impact your credit score. What information does your credit score not consider? Now, there are several factors that your credit score does not take into account. Some of them are things that they can't take into account because of law. This includes things like your gender, your nationality, your race, your marital status, things like this. They also can't factor in your age. They are not allowed to factor in the amount of money that you make, the type of job you have, or where you live. However, it's important for you to know that even though the credit scores don't take that into account, oftentimes that is something that lenders take into account as part of their loan application process. And finally, the other thing that your credit score does not take into account is what is called soft inquiries. All right, so this leads me to my second little side note. It's really important that you understand the difference between what's called a soft inquiry and a hard inquiry. So a soft inquiry is looking into your credit score yourself. It's something that you can do, for example, using one of those websites. You do it, a lot of banks have this feature. If you have a bank credit card, you can check it on their website when you log into your profile, things like this. Those are called soft inquiries. Now, a hard inquiry is when an institution, particularly a financial institution, makes an inquiry on your credit score. So for example, if you decide that you want to buy a car and you need a car loan and you go to the dealership and then they make an inquiry about your credit score, that's what's called a hard inquiry. And just like what I had mentioned before, opening up too many lines of credit at the same time, if you have a lot of people doing hard inquiries on your account, this can negatively affect you. So it's really important that when you're doing your loan shopping that you are selective about the inquiries that are hard that are able to be made on your account. So if you can do your shopping in advance to try to get prices based on ranges that you'll think you'll be in, this will be to your advantage. Of course, at the end of the day, nobody's going to sign a contract with you without doing that hard inquiry, but just know that soft inquiries don't affect you, but hard inquiries, they do affect you. All right, now we're on to the best part of the video. What can you do to improve your credit score? Well, the first one is really simple, and it is to pay your bills on time. This is the number one thing that you can do to boost your credit score and to keep it consistently high. It's really important that you pay your bills on time. Now, my personal advice for this is to set up auto debits from your account at least 48 hours before your bills are due. This is something that really helped me a lot on a personal level. When I was younger, I used to be late on my bills all the time, and I would always get those email reminders, hey, your cell phone bill is 1 week late, we're gonna shut off your service. It wasn't because I didn't have the money, it's just because I forgot to pay it. So I think setting up an auto debit is a really great piece of advice that I can offer to help you pay your bills on time. Tip number 2, keep your balances low on your credit cards and other forms of revolving credit. So something we haven't talked about thus far in the video is something called credit utilization. And it's really important for you to understand it because this is something that lenders look at. So basically what credit utilization means is it is the ratio of the money that you have available to you through your credit versus the actual amount that you have spent. And most lenders want to see an individual with a utilization rate of around 30% or lower. So for example, if you have a credit card that the maximum limit is $10,000, it's important for you to try to not put more than $3,000 on that credit card. So you're not utilizing more than 30% of the credit that is available to you. That's just a good green flag for lenders, and it's going to help you out in the long run. So my particular tip around this is to, number one, never put anything on a credit card that you can't pay off at the end of the month. And what I personally do is I like to put a few recurring monthly expenses. So for example, I always auto debit my Netflix payment every month on a specific credit card. And so I know that it's going to be charged to the credit card, and then I make sure that my actual savings account and my checking account pay off that credit card balance. So it's this nice little cycle. So I continue to have my credit utilization score, which keeps my credit high, and I use my bank account on the other side to make sure that I'm paying off my credit card. So I don't incur any interest on my credit card, but at the same time, I keep that utilization going, which continually improves my credit score. So that's my best tip for you. Tip number 3. Only apply for new lines of credit when you actually need them. Don't open up different lines of credit because you want to have a good credit mix, because that has a good chance of actually harming you in the long run. Unnecessary credit can harm your credit score in multiple ways, from creating lots of hard inquiries to tempting you to spend more money. So if you don't need a line of credit, don't apply for it. Tip number 4, don't close your unused credit cards. Now, this one surprises many people. But it's important for you to understand that keeping a credit card open only makes sense if you're not getting charged an annual fee. Now, the reason why this can sometimes help your credit score is it can boost that utilization that we had talked about earlier. So for example, if you have a credit card that has a $5,000 limit that you are no longer using, if you keep it open, it's as if you have access to that $5,000, but you're not using it. So it can help you to lower your utilization rate. But again, it's really important that if you're going to keep a credit card open, it only makes sense if that credit card does not have an annual fee attached to it. You don't want to be paying money for nothing. Tip number 5. Don't apply for too much credit, resulting in multiple inquiries. So in most cases, these hard inquiries will stay on your credit score for up to 2 years. So it's really important that you don't go crazy and just apply for a whole bunch of new credit all in a short period of time. It's going to end up hurting you in the long run. Tip number 6. Dispute any inaccuracies that you find on your credit report. So it's really important that you monitor your credit, that you have a good understanding of what's on your credit report. And if you take time to review it, you might find something that is not accurate, and it's important for you to dispute it. So let me give you a personal example. When Chris and I decided to move to Australia and we left the US, I had a T-Mobile account, which I had had literally since I was 15 years old. When it was time for me to leave, I thought I had gone to T-Mobile and done everything that I needed to completely close out the account. Long story short, a year later, it turns out I hadn't. And so there was this payment of like $50, which apparently was really negatively impacting my credit score. And so I didn't find it out until I ran my credit report. I was like, T-Mobile, what the heck is this from? Anyway, I was able to call the people that T-Mobile had sold the debt to, and I was able to talk to them and say, listen, let me just transfer you the money right now over the phone with my credit card. And within 48 hours, it was completely cleared up. So it's really important that you understand what's on your credit report. If there's anything that you can fix or that you can dispute, go ahead and do that. Moreover, monitoring your credit on a regular basis is going to allow you to spot inaccuracies before they can do any damage. All right, and tip number 7, and this is for you folks who have a lower credit score than what you would currently like to have. If you're in financial trouble, if you need help, it's really important that you reach out and seek that help. Don't be silent, don't be quiet. There are lots of opportunities for you to seek help to improve your credit score and to work on getting your debt paid off or forgiven or negotiated. There's lots of different options for you, so it's really important that if you're struggling with your finances, if you're struggling with bad credit, don't be quiet, don't suffer alone. Make sure that you get the help that you need. All right, guys, in conclusion, there are a few key takeaways that I would like to leave you with. Number 1, your credit score is super important because your credit score is what informs a lender of your credit worthiness. The most important score that you should care about is your FICO score because that is the one used by majority of lenders. You have multiple credit scores, so it is important that you know what you are looking at whenever you pull a credit report. And there are a number of ways of improving your credit score, but the best thing that you can do is to pay your bills on time, keep your debt low, and only open new lines of credit when you really need it. All right, that's it for me. I hope that you found this video useful. If you did, please let us know by liking or better yet, subscribing to our channel. Remember, earn more, spend less, and invest the rest, and I'll see you next time.